Welcome to Manifested Publishers. My name is Mr. Mariga, and I'll be teaching you Advanced Management Accounting. Yeah. Now, today we will talk about a topic known as budgetary control and what? Techniques is the topic I want us to talk about. And a budget, we normally say it is a forecast. It is a quantitative forecast statement. Forecast statement that will show expected performance. That shows expected performance. Expected performance. Okay. Now we have various ways of preparing budgets, or various methods you can prepare budgets or budgetary systems. Namely top-down, bottom-up, rolling, zero-based, activity-based, budgeting, incremental, and feed-forward methods of what? Budgetary control systems. But all these systems of budgetary control, we will talk about them in future lessons or before the end of this particular what? Topic. Today, I want us to talk about something still related to budgets, which is use of operational variances. Use of operational variances. Variances to reconcile original budgets with actual performance. With actual performance. Okay. So let me start by explaining what an original budget is. Let me start by explaining what an original budget is. Now, an original budget is a quantitative forecast statement normally prepared at the beginning of the period using what we refer to as budgeted information. So this is a budget of budgeted activity at budgeted what? Costs. At budgeted costs. There. So this is a budget that you only consider budgeted items. For example, if you want your budgeted sales, you're going to take your budgeted selling price, you multiply by your budgeted sales volume or units sold. If you want your cost, you're going to take your budgeted activity, you multiply by your budgeted costs. So we are saying this budget, you strictly prepare it considering budgeted activity and budgeted what? Costs. For example, let's go to August of 2023. August of 2023. August 2023. Question 3A, which is known as Zeta Limited. Zeta Limited. Is saying Zeta Limited manufactures one standard product branded Bomber and operates a system of variance analysis using a fixed budget. As the assistant management accountant, you are responsible for preparing the monthly operating statements. The budgeted information of product Bomber for the month ended 31st of July 2023 was as follows. You have your selling price per unit, your cost per unit, your material A is 2 kgs at 100 per kg, B is a liter at 150 per liter. Labor, you have 3 hours at 90 shillings per hour. Variable overheads, you will have 3 hours at 20 shillings per direct labor hour. Zeta Limited budgeted sales and production for the month of July was 10,000 units. Annual budgeted fixed overheads were 14.4 million, which are assumed to be incurred evenly throughout the year. The company uses marginal costing system for internal profit measurement purposes. The actual data for the month of July was as follows. Actual production and units sold, then selling price. Direct materials consumed, you have 19,000 kgs consumed at a cost of 90,000. B, 20,000 liters consumed at a cost of 14,000. Direct labor incurred 28,500 hours at a cost of 27,36,000. Variable overheads incurred is 520,000. Fixed overhead incurred is 1160. Required. They're asking for a budgeted profit statement. So the first requirement is budgeted profit statement. Your budgeted profit statement, is another word of saying an original budget statement. An original budget statement. We are going to take our budgeted activity, but we consider our budgeted what? Cost. For example, since they want us to prepare a profit statement, we know that when you're preparing a profit statement, one of the items you want to determine is whether you have a loss or a what? A profit. So we are going to start here with our sales revenue. Our sales revenue. And your sales revenue will be your budgeted sales activity, then you multiply by your budgeted selling price. Your budgeted sales and production was 10,000 units. You multiply by your budgeted selling price of how much? 880. 10,000 by 880. So this in thousands of shillings should be 8.88 million. Then we less our what? Our costs. We will less our costs. And how will that be? The first cost will be the cost of direct materials. Direct materials. You had two types of materials. The first was A and the second was B. So you're going to take your material cost per unit, you multiply by your budgeted production. So you take 10,000 multiplied by your budgeted material cost per unit of who? 200. B, your budgeted activity is 10,000. Your material cost per unit is how much? 150. Let's go to direct labor. Direct labor, again, what do? You take your budgeted activity, you multiply by your budgeted labor cost, and this will be your budgeted activity is 10,000. You multiply that by your budgeted labor cost of 270. Then variable overheads. Again, you take your budgeted activity by your budgeted variable overhead cost per unit. Your budgeted activity is constant at 10,000. You multiply by your budgeted variable cost per unit of how much? 60. Of 60. To that, you're going to also less your budgeted fixed overheads. We had been provided the budgeted fixed overheads given by note number what? Number 2. And your budgeted fixed overheads were 14.4 million. So I'm going to write there 14,400. This is 2,000. 1,500. 2,700. 6 what? 600. $12,400. That is what you're going to refer to as your budgeted profits. Your budgeted who? Profits. There. Right. The next statement that they tell us to prepare is what we refer to as a flexed budget. A flexed or a flexible budget. Now, a flexed or flexible budget here is basically a budget that will consider actual activity but at budgeted cost. So this is a budget of actual activity, but this activity, you're going to value it at the budgeted what? Cost. So this is a budget of actual activity at budgeted what? Costs. Budgeted what? Cost. Now, when you're preparing this particular flexed budget, you must consider the behavior of costs. In that, those costs that are variable, they will change. They will change, okay? Such that you're going to consider actual activity at budgeted cost for variable cost only. And what variable cost do we normally have in an organization? You may have direct materials, you may have direct labor, direct expenses, variable production overheads, variable selling overheads. For as long as a cost is changing with output, you will take your actual activity then at your budgeted what? Cost. But there are other costs that do not change with activity, known as fixed costs. So the fixed cost, by virtue that they do not change with activity, you are only going to consider their budgeted costs. So the budgeted cost of fixed costs should not differ. It should be the one you're also going to consider when you're preparing your flexed what? Budget. We can even do this August 2023 again. It was not a requirement that we do a flexed budget, but let me use this August 2023 to do a flexed budget. All right. We can start with flexed profit statement. The flexed income what? Statement. I'll have my values in thousands of shillings. When I'm preparing this statement, I will start with my who? My sales. I come here and write what? Sales. Sales revenue. Remember, your profit is simply the difference between your what? Your revenues and your costs. Your revenues and your costs. Your sales revenues here will be the actual sales revenue. Your actual sales revenues and your actual production and units sold will be 9,000. So your actual sales will be 9,000 units. You multiply by your budgeted selling price. And your budgeted selling price per unit was how much? 880. Then you less your costs. You less your costs. Start with direct materials. Again, your materials, what do? You take your actual activity, you multiply by your budgeted material cost. You had two types of materials. The first material was A and the second material was B. Your first material was A. You're going to take 9,000. That is your production. Your material cost per unit was 200. Your material cost per unit that was budgeted was how much? 200. Product B, your production is 9,000. Your material cost per unit of B was how much? 150. That had been budgeted. That had been budgeted. You deal with direct labor. Your labor cost, again, what do? You take your budgeted cost multiplied by your actual activity. Your actual production is 9,000 units. Your budgeted labor cost per unit is 270. The next cost is a cost known as variable overheads. Variable overheads. Again, this is a variable cost. You're going to take your actual activity multiplied by your budgeted variable cost. Your actual activity was 9,000. Your budgeted variable cost per unit is what? 60. So let's identify. And this was a loss. That was a loss because it is a negative. $79.20. 1.8. 1350. 2430. 540. Now, the other cost we should include here is your fixed overheads. Your fixed overhead cost, we've said, this cost does not change with output. Therefore, you're going to take the budgeted cost to be the same as your fixed cost, or your flexible cost to be the same as your flexible cost. So your budgeted fixed overhead was 14,400. So So that should not change. Why? Because you know your output only changes what? Variable cost, but fixed costs do not change as a result of changing what? Output. Therefore, the fixed cost will remain the same like what you had budgeted for. Get our flexible or our flexed profit or loss. $2,900, $79.20, that's $1,800, $1,350, $2,490, $2,430, yeah, not 90, $540, $14,400. It's a loss of 12,600. Of 12,600 what? 100. All right. That is a flexible or flexed budget. A budget of what? Actual activity, but at budgeted what? Cost. The third statement, the third budget that they sometimes tend to ask is your actual budget. An actual budget is prepared for actual activity and for what you actually incurred. So this is a budget of actual activity but at what? But at actual what? Costs. So it is a budget for actual cost for the actual activity that was done what? Undertaken. That was undertaken. Let's using August 2023. Using August 2023. Question 3A, part 2 now. 3A, part 2. They are asking for an actual profit statement. So let's prepare an actual profit statement. Actual profit statement. We start with our sales. Start with your sales. And how much was your sales? You're going to take your actual quantity sold, you multiply by your actual selling price. Your actual quantity sold was 9,000. Your actual selling price is 900. Then we less our who? Costs. The first cost is the cost of direct materials. Direct materials. The first product material. This product is material A, and the actual cost of materials was how much? 2090 for A. B was 1414. That is your actual material. Then the next cost is the cost of direct labor. direct labor, and your labor is incurred. They use 28,500 at a cost of 2736. The third one is your variable overheads. You actually incurred 520. Then you have fixed overheads incurred. And your fixed overheads were 1160. 1160. These will give us our actual profit or loss. Actual profit or loss. So your actual profit or loss will be a profit of 108. 108. Right. 108. Right. That is how we prepare 1. Original budgets, 2. Flexible budget or flexed budgets, 3. Actual what? Budgets. Actual budgets. Now, if you look at all these 3 budgets here, they are giving you different values of profit. Here is 12,400. That is a loss of 12,600. And finally, the actual budget has a profit of 180. 180 is the actual profit that was realized. Now that these profits and losses are very different, we can be able to reconcile. Okay, we prepare now a reconciliation statement. Why? So that you identify or you reconcile these different profits that have been obtained. You reconcile your actual profit with your budgeted what? Profits. And for us to do that, we prepare or we must study what we refer to as variances. What we refer to as variances. And that is what I want to introduce next. Operational variances. Operational variances is what I want to introduce next.